The Fed is losing control of interest rates as we see rates rise to over 7% this week.
Yeah, I know. Trump's pissed, right?
Yeah. It's not a Powell issue, though. It's not a Powell issue.
I agree. I mean, they're laying these tariffs on us, I guess.
Mm-hmm.
I guess we got a 90-day pause on most of them. But, the Fed's job, of course, one of their jobs is they have a dual mandate. One is to obviously maintain pricing, right? It's pretty hard to maintain pricing when the president's issuing tariffs.
Right. When you say maintain pricing, you mean, regulate inflation.
Yeah, essentially. Yes, right. And so they have that dual mandate, right? One is unemployment and the other is inflation, basically. But it's really pricing. So I think that's it's going to be interesting. And I actually don't think that we've really seen what we're going to see from these tariffs.
Well, I think what's interesting is that, typically the bond market reflects the Fed. And so, we always have relied on the Fed to set rates, even though they're not really setting the rates. The bond market is, but it follows, how the economy is doing and everything else. Well, now, we have the Fed that has paused anything with rates, but rates are continuing to go up. And that's because of the bond market and how investors are feeling about investing in U.S. bonds.
Yeah, and real estate in my world is priced by the 10-year. Not the Fed fund rate is, that's a lot of people focus on that. And I guess they're looking at 2 to 3 potential cuts, but the 10-year's up. So as the Fed funds rate has gone down, the 10-year's gone up. So that just makes a lot of the commercial real estate, at least, harder. And
it makes everything
mortgage
harder.
rates are up.
Yeah, it makes mortgage rates go up, which inevitably makes it harder, if you're selling your house or if you're trying to buy a house, whether it's an investment or not. But I think that, a lot of people, in order to understand this, you have to understand what treasury yields are and how this kind of all works. So basically, and you deal with this a lot when raising money from investors. So a treasury bond is the safest investment you can make, right? Because it's backed by the government, the U.S. government. So, whatever that is set at, you have to then set any money you raise or any your mortgage-backed securities, different things like that, higher because there's more risk. So that's why interest rates have to be up, because if investors are demanding that these security bonds or treasury bonds are at a higher rate, then everything has to be higher than that.
Right. There's a bunch of things. There's crosscurrents going on all over the place, right? Mm-hmm. We've talked about this on the channel, but I think it's important to mention that if you're a country that's doing business with the United States, let's just talk about China, all right? Let's say that we're buying stuff from you, and I pay you in U.S. dollars, and they're frustrated with holding U.S. dollars. In fact, the U.S. dollar just got downgraded, right, from AAA to AA.
Yeah, we'll chat about that.
Yeah, so there's that. So you do have that as well. In addition to that, you have this. I think that the tariff, the potential inflationary issues with regard to the tariff. So you have all of these things going on at once, and the Fed's in an interesting position. And I just got done speaking at the Rebel Capitalist 2 days ago at George Gammon's event down in Orlando. And it was really interesting because we had a bunch of economists there, some really, really smart people that study the macro, including George. If you guys don't follow George, you should. And what everyone's consensus was, this is very interesting, is that interest rates, they think they're going to have to go back down to zero. Mm-hmm. Very interesting.
But does it matter if it goes back to zero, if the bond the Fed, that's what I'm saying. The Fed's losing control. So they could control rates, but they can't if the bond market's uncertain.
That's right. Because they don't have any influence over that.
Right. None. And you have to understand why the bond market is uncertain. And part of that is because, we were downgraded on our credit by Moody's. And that's one of the things. And the other thing is that these people that are investing in the bond market are expecting inflation. So, you have to give them more interest for that, right?
Correct.
Like if you're paying, 3%, well, they're looking at inflation. Like if I invest my money and I get a 3% return, I'm not making any money, and in fact could be losing money. So I want, 4.5% or 5%. And then people investing in the mortgages have to say, okay, well, now I want more than 5% because I can get 5% over here. So I want, 6.5%. And then that's why you have these interest rate increases, and the Fed, there's nothing that they can do. And they're basically losing this tool in their tool belt if people don't want to invest in the bond market.
Well, some people are saying right now that the Fed actually might not be in control of this at all.
Yeah.
The 10-year, right? And the bond
Right.
market, clearly we know they're not, right? So yes, they do have the federal funds rate at their, they can control that, and they're expecting to have, I think, 2 more cuts this year. We'll see. But the one thing is for sure, Trump's tantrum, what they call it, Trump's tariff tantrums, I think. There's no love lost between him and Powell. That's for sure.
There's not. And the tariffs are creating uncertainty, and that also is affecting the bond market because we get a lot of foreign investment into the bond market. It's not just U.S. investment. And if people don't understand what's going to happen with inflation, and they don't understand what's going to happen with the tariffs, and it just creates less demand for the bond market, which is why gold prices and crypto prices are shooting through the roof, because those people that normally would be investing in more bonds and things like that are turning to something more national.
That's why I went earlier to the international thing, because I as we pay people and they're holding U.S. Treasuries, because that's what they're holding. I mean, people say they're U.S. dollars, but they're really U.S. Treasuries. And if our dollar is becoming weak, it gets downgraded, and also they see inflation coming. There's an issue around a safe haven. Is the dollar a safe haven? And that's actually, I think, what we witnessed. We just got back from, we were in Paris, we were in London, we were in Italy, and the $100 bill gets you a lot less than it did just a year ago. In all of those places. And so, let's don't forget the other side of the issue. A lot of times if you don't travel abroad, you're not seeing this effect. And so you have all these cross currents happening at the exact same time. Mm-hmm. And I think Powell's gonna, he's gonna step down in next May. So he's in place for another year, and Trump's not gonna be able to touch him, regardless of, you guys probably know the Federal Reserve does not have anything to do with the U.S. government. It's a private corporation. Some people would call it a banking cartel, but the fact is Trump has zero influence over it. Now, he is going to appoint the next chair.
I was going to say, but he does get to appoint the next chair.
And that's kind of where I'm heading.
But he appointed Powell.
Correct.
So, you never know what you're going to get. After somebody gets the job, they kind of can do what they want.
It's a hell of a point. But I will tell you, so Trump gets to pick the next person who's going to be in there next summer. So it's going to be really an interesting year, because the tariffs, they're all going to be kind of exposed by that point, right? We're going to kind of know. Yeah,
but also if you think about it, okay, say the new chairman, they lower rates, right? I know that they can't just independently do that, but let's just say that happens. If that sparks more inflation, wouldn't it then potentially, people that wanted to invest in the bond market want even a higher return?
That's my point. Yes.
Right.
Yeah. And then, let's don't forget that the other piece of the mandate for the Fed is unemployment. Now, while unemployment is reportedly, I guess in April, was 4.2%. Guess what it is in D.C.? Guess what it is in California? Guess what it is in Illinois? Guess what it is in Michigan? In the mid-5s.
Yeah.
So in D.C., it's 5.6. Now that's probably doged, the people probably got doged there. But you start to look at California, Michigan, Illinois, and some of these other states. They're in the 5s. And so
when I'm starting to hear of people losing, like I'm starting to know people that are losing their jobs, I think it's more unemployment is coming for sure.
Yeah. We talk a lot about this, guys. In the middle of all of this, I don't want to go too far down this rabbit hole, but if you guys haven't really jumped onto this ChatGPT AI train that a lot of people are doing right now, you take a look at book writers, copywriters, anything that's can be processed, accounting, attorneys, right? Like I got this. I showed Danille this over the weekend. I'm working on something. I got this term sheet. It's like 12 pages, all legal, all attorney, all oh my gosh, like if, then, thereofs, all that kind of crap. Like the really hard stuff to read. I don't know about you guys, but I struggle through that stuff. Sometimes I have to read it 1 or 2 or 3 times. So what did I do? I sent the whole thing to ChatGPT and I said, what would you do? How would you renegotiate this 12-page contract? And it gave me like a whole list of stuff to do. The point is, I'm old. I'm learning this stuff for the first time. There are people that are rolling on this stuff right now and building huge platforms with this. The truth is, and where this is all heading is, there are going to be a fair amount of advertising, marketing, attorney, accounting, all this stuff.
Every job other than service
really,
based.
I'm telling you guys, like this is something. Has obviously nothing to do with this administration or the Fed or anything like that. But I was talking to George Gammon. He thinks, as a result of all of this stuff together, that we could get up to 10% unemployment. Now, for those of you who think I'm out of my mind, I was in the middle of this in 2008. Some of you might remember we were at 10% unemployment. So it can happen. And so this is another piece for the Fed.
Well, and we very well could have stagflation. Like I think stagflation is a very real thing that could happen. I mean, you would have drop in wages, high unemployment, and inflation. And in 2008, we didn't really have inflation.
So the three things for stagflation, you nailed them. They're high unemployment, they're slow economic growth, and high inflation. Those are the 3 things. A lot of people are calling for that. I think the last time we really saw that was in the 70s. I can't remember the Fed chair at the time, but I think he started jacking rates up. Was it which one? Paul Volcker. Yeah. I remember coming out of high school. And I got my first car. I remember just like it was yesterday. It was a Nissan Maxima. That was my car. It was a used Nissan Maxima, but my interest rate was 15% for that car. And I remember, and I'll tell you, at the time, of course, as a kid, you don't know any better, right? But who knows? Who knows the levers? I will tell you something really, really interesting. I did a comparison at the George Gammon event. What was the difference between 2008 and 2025, let's say? Because a lot of people are comparing that. I think a lot of times the reason they compare that is because they just want to go back to the last, wild time. And the great financial crisis was tough. Here's the biggest difference. So I did a lot of work on this before I did my presentation. We had a lot of people building homes during that period of time. And so we were oversupplied on the single family side. And when the bubble popped in 2007, 2008, there were 4 million homes on the MLS. Okay, that's a significant difference. Today, a lot of people have a lot of trapped equity. And I think we just crossed over 1 million. So we're not even close on the supply side. So for a lot of you guys that are thinking, oh my gosh, we're going to have this real estate crash, which is of course the whole point of this channel. I don't agree with that at all.
Well, let's chat about what it does mean for real estate, though, because there is definitely going to be repercussions if rates stay high, and especially if rates continue to go higher. Because one thing that it does is it crushes buyers' affordability. Like, they just can't afford to buy. And we're starting to see that now. You know, we're really seeing home sales really almost come to a standstill. You know, I mean, things are selling still, but it's slowed down.
Yeah.
You know,
well, the prices are high and interest rates are going up.
Exactly. And people can't afford it.
We cracked 7%, right?
Yeah. But the thing is, though, is that I'm seeing a lot of delistings, right? So the people that are selling have to sell, but it's not like 2008 where people are giving their homes away because they don't have to sell. They're in like a, 3% interest rate or something. So they just don't need to sell their home. So it's like they're not just going to give it away just so they can buy a different home, right? So you're not seeing that, but you are going to see prices drop for people that have to sell their home, I believe.
Oh, yeah. I agree. But I will tell you, it's a very different scenario because I went through this. If I'm sitting on a lot of equity, which is exactly the majority of the Americans are sitting on a tremendous amount of equity. Don't forget the other side of the equation. If prices are high and they've gone up a lot, that means that people are sitting on a fair amount of equity. That's one of the biggest differences of 2008. So you're right. They have a lot of wiggle room, which is really good. That also means that all it's going to do is really eat into the equity that they've already got. If they sell, right? Things are going to be on the market longer. Days on market, we're already seeing that. I looked, I think we're at like 8 months on the average, days on market, something like that.
Well, days on market in Phoenix is like 60 some days.
It depends. Yeah, it does depend. But if you take a look at, I was just in Florida. Florida's in trouble.
Florida has the really slowest market, I think, right now.
Yeah,
well, there's more dynamics though going into that than just the market itself. Like they have a lot of condos for sale because they passed some kind of new law that condos have to have all these reserves. And so the HOA cost and also just different assessments have been hitting a lot of condo owners. So a lot of condos are listed, and that's going to even affect single family because if condo prices are going down, single family prices kind of move not along with them, but a little bit, you know?
I agree.
And so you're starting to have this mass exodus on Florida.
Well, also let's not forget part of a deflationary time, which is, really what you can categorize Florida as going through. On the other side of that, it grew and appreciated much, much faster than most of the markets. So like if you're comparing this to, let's say, Columbus, Ohio or Cleveland or whatever, where Danille's from, you never had that run up and you're not going to have that retraction. So a lot of people, I think this is a really interesting point too. A lot of people think you either have deflation or inflation. You actually have both. The question is, which one is actually pulling the hardest? So you can have deflation. Just think of an iPhone or a TV set or whatever, anything that you buy, a car. Those are deflationary. And so you can have lots of different things happening at the same time. And so the real issue is which one's pulling the hardest. And I think with these tariffs, we might be able to, this might be a very interesting time where we might see, to your point, Danille, high inflation and high unemployment. And if we get into this piece, then we could be sitting in a pretty severe stagnation time frame next week. The Fed is going to be in a really, really, really tough spot. I think they're going to have to massively cut rates.
But I don't think, but it's not going to matter if the bond market doesn't follow through. Then it's not going to matter if they cut rates.
I think though if they're going to have to be in this position because and the problem with that is it's going to create another bubble. But if you're sitting in if you personally are sitting and you have a 3% mortgage rate on something, and the rates go down. Then you're now going to be in a position to either sell or move lateral.
But why would rates go down? Because the bond market is the one running this. If the Fed's cut and the bond market doesn't feel secure, I mean, it's not going to matter if they cut.
Yeah, it's a fair point. But we don't know what the bond market's going to be in a year.
We don't. And we don't know, what the Fed's going to do. I mean, these tariffs really are creating a lot of unknown situations. But right now, investors are not wanting to invest in the bond market like they have traditionally.
Right. And that's a massive problem.
But you do have to look at the buyer affordability because, rates are 50% higher than they were, over 50% higher than they were back in like 2021. So people's payment has literally doubled. And so there is a cap on what people are going to pay to buy a house, based on their rates. Like, we saw a dip in rates about a month and a half ago and they dropped to 6.25. A lot of houses did sell that weekend, but now that they're back up over 7, people just can't afford it. And, that turns more people to rentals, but it also makes people that have to sell lower their prices. That if you have to sell, you have to sell. So whether you're going through a divorce or you got a new job and you have to move or whatever your situation is, we're seeing lowering of prices due to that. We're not seeing anything dramatic, but you have to meet people where they're at these 7% rates.
But I do like the phrase, the cure for high prices is high prices. I mean, that's a truth. Like, they can only run so much. And then they stabilize. And then now we're starting to see days on market. The reality is if we're looking at this from a single family standpoint, I personally don't see any real relief from the pricing. Maybe we start to see a slow on the growth of the on how fast it's growing. But if you take a look at Zillow or Redfin, they're all saying somewhere between 2 to 3 to 4%. I don't know if that's going to happen or not, but that's what they're saying. But they've been saying that year over year over year. On the affordability side, which we touched on a minute ago, I think that's one of the bigger issues because what you have is you have these now 7% interest rates with these prices that aren't really going anywhere, and you've got people now that are defaulting into rentals, and right now we're at 65% home ownership rate. We were as high as 69%, back in the 2008. And I think this is going to regress. I've been talking on this channel about Renter Nation. There's a lot of things that have to change for people to be able to move from a rental to a home. And the delta between a mortgage payment plus all the costs to maintain a home versus rent is significant. It's not even close.
Well, and you have to look at 91% of homeowners have a mortgage rate under 5%.
Right.
I mean, that's huge. 91% of people. So
those
people are going to hold the line unless they have to sell. And they're not going to be selling because they can't afford their payment in almost every circumstance because those payments are not a lot. They're very, very low housing payments. So more often than not, it's going to be a job transfer or something like that. But you're not having any additional building right now. If anything's being built, it's being finished. And that is going to create, for renters, less supply and more demand. Because us landlords the last couple years have been seeing like an oversupply of rentals, and we're still dealing with that right now. I'm dealing with that right now as I rent out my place. But now that nothing else is coming to market and people are still moving to an area, that's going to start to saturate. And so you're going to start to see more of a demand on rentals and higher rental prices in the next few years.
Yeah. And if you guys are as confused as we are, because we do try to prepare for this stuff, but man, stuff is coming at us. Join us on Thursdays, free. This is free. We got Kiyosaki himself and Robert and Tarl. If you guys don't know Tarl, he's my partner in Limitless. He has done, I think, in like 900 homes or something, single families. Like, he's crushing it on the single family side. Right now he lives in Austin, but he used to live up in Seattle. And myself, and we are going to try to figure this out. So I just saw Robert, and I said, let's talk about the dollar reset. Where are we heading, and what's the Fed's next move? So that is free, guys. 7 p.m. Eastern and 4 p.m. Pacific. Please join us for that. And of course, I was calculating the 90-day mark on this, I guess this pause for the tariff pause that's going to put us right before limitless, right? It's going to be really, really, really interesting. So one of the things that Tarl and I are doing is we're putting together a manufacturing panel, right? And so far, we got some really, really exciting companies that are doing business outside of the U.S. and have a lot of their stuff done in China, in Mexico, in Europe, and all different parts of Asia. So anyway, that's going to be at Limitless too. Don't Jerry, you want to put that up real quick for those of you guys? There is a price increase at the end of this month. So make sure you go there, check it out. I can't remember off the top of my head what it is, but I do know that it goes up at the end of the month. So you're going to want to, if you're going to want to join us and you're as confused as I am, we are going to try to figure this out. We're going to have panels on all this stuff. This year we have Jim Rickards too, by the way.
So the other thing with investors right now is it's getting harder to make cash flow work. So that will become easier as prices come down and rental prices come up.
Well, when is that?
Well, it depends. I mean, prices have to come down. And when rates are this high, prices have to come down if people want to sell. We're already starting to see that.
Yeah,
and that's what happened. That's what happened in the 70s when you had stagflation. You had prices of the homes go down and rental prices go up.
I guess there could be a case for that over the long term. But I guess this year, I don't see them coming down.
No, not necessarily this year.
You don't know. I mean, maybe next year. I mean, on my side of the equation, on the multifamily, prices are down. As a result of the cap rates have gone up, interest rates have gone up, expenses have gone up, and vacancies gone up. So all of those things have really adjusted or jolted the commercial side of the market, the real estate market, which is where I play mostly. On the single family side, you know, but to your point, you got 91% of America sitting, 5% or under?
You do.
So why would you?
But you also have inventory, at least in the Phoenix area, is back over where it was in 2019. So we have increased inventory from 2019 when we had a pretty healthy market. So it's really switched to a buyer's market right now, and it's continuing to become more of a buyer's market as we head into summer.
Yeah, and I think that's not necessarily bad.
No, it's not a bad thing, and it doesn't mean prices are crashing. But what it does mean is if rates stay this high and continue to go up, you're going to have people that have to sell their house. And if there's not that many buyers, they have to lower their prices. And you're starting to see that. And so to your point, I don't believe there's going to be this massive amount of supply because people that don't have to sell aren't. But there's enough people that have to sell that it's going to influence
So
the
that's
market.
The piece that I don't know about. Like, who are those people?
They're people that are moving, getting a divorce. They're people that, I mean, I guess if they're in a position to, they have to sell because they've expanded their family.
Always is going to be that.
Second homes are a big one right now. Airbnbs are a big one right now. So there's all these people that are having to sell. There's investors that were barely cash flowing and now they're not. So there's enough people that it is hitting where we're above 2019 levels.
There is a bit of churn in that arena. But the people that are sitting at 91% of the people that are sitting at 5% or under that don't have any of those things going, which is the majority, that's a big decision.
Yeah, and I don't think that those people are going to sell, but I think there's enough of the other people to affect pricing.
Well, we'll see. That's the piece I don't know.
We're seeing it though. We are seeing it. If I'm on the MLS every day. I mean, you're seeing prices dropping. You're seeing things sit. And now that we're going to summer, which is Phoenix's slow season, you're going to see it even more. Now, I am seeing people pull things off the market because I believe if they don't have to sell, they're not. But there's a lot of people that have to sell, and there's not that many buyers. And buyers are, they're looking at these 7% rates and they're high. I just had one of my clients text me yesterday, like, I think rates just went up because they're already looking at like how much they're going to have to pay monthly.
Well, I think you nailed it when you said there's not that many buyers.
Right.
That's actually the real issue.
Because they're priced out.
Yeah.
There would be. There's a ton of people that want to buy, but when your housing payment from 2020 till now doubled, it's very expensive and a lot of people just can't afford it.
But if you look at nationally, not Phoenix, we're still just barely over 1.1 or 1.2 million on the MLS.
But that's mainly from the Northeast is really contributing to that because they don't have much supply at all. But, like Texas, Arizona, Florida, different parts of the country are oversaturated.
60 days on market. To me, that's not healthy. That's a seller's market. for me.
Yeah.
If 60 days on a market is a seller's market.
But it's went up, but you have to look at how much every month it's going up significantly. So yes, right now it's 60 some days, but I bet the end of
but if you look
May, it'll be more.
If you look historically, what they say, whoever they is, I always wonder that question. They say that it's 4 to 6 months MLS. That's considered, I guess, neutral. So that would be where something's on the market 4 to 6 months. And that is considered, it's not necessarily a buyer's market. It's not necessarily a seller's market. It's just about right if you look at history. So 60 days, if that's where we are today, 60 days, I still think it's a little bit of a seller's market. But there are definitely markets. By the way, this is kind of new. So
do you feel like it's a seller market, or do you look at data somehow to know it's a seller market?
Well, you told me it was 60 days. I'm gonna believe you, and I'm gonna go off of history that says it's 4 to 6. So that's where I am.
Well,
but also I'll give you one thing. This is kind of new, so we're just creeping. So days on market is kind of a new phenomenon. I'm with you. I don't think there's a lot of buyers. And so the days on market is going to continue to go up here through this year. I do believe that. And so we could be sitting on a very, very different scenario at the end of this year. So because stuff that's not selling in 60 days still has the same issue, not enough buyers. So maybe that's 4 months, maybe that's 6 months down the road. Some of those homes still potentially could be for sale.
Right. But I do think that just moving forward, it will be interesting to see what it does. But as investors, we shouldn't freak out because prices go down. Because I think people freak out like, oh my God, I should probably sell my rental because prices are going down. We're looking at that cash flow, and rents in these kind of times go up because there's more renters and people can't afford to buy. And they're not building any new construction right now. So the demand will be greater than the supply. So, people try to time the market, right? They always try to time it. Like they want to buy at the low point and sell at the high point. But realistically, in these times with inflation, rents are going to go up. So if you're in this set mortgage, then you're good. You'll be fine. You don't need to freak out just because housing prices might drop.
No, guys.
And people freak out over that stuff.
Yeah, I guess. I mean, like if you're in the business for cash flow, passive income, and long-term and tax benefits, then why are you even looking at it? Like, I get the fact that you might want to take a look at it just from a comfort level, but if you feel really good about the renter in there and where things are heading from a renter standpoint, then who cares? Who cares if your house goes down $100,000? Seriously, that's the way I feel. I don't care because rent's not. Rents are, although right now rents are getting clobbered a little bit, which is why I'm going crazy buying. So we're very excited about the acquisition time frame for apartments, but that drops off a window here very soon. By mid-26, the supply just stops because when rates started going up in late 2022, after inflation hit 9.1 in June of 22, people started pulling back. The new construction, new housing. So it just didn't come to a standstill, but in 22, things slowed down. In 23, they slowed down. In 24, they slowed down. And people said, I'm just going to wait and see where interest rates go for construction. And so Danille's right about the construction. There's not a lot of new construction happening. And so there's a time frame right now, this little window we're in, where and I just don't see a big adjustment on the single family housing side. I do see days on the market. Maybe the buyers are in many, certainly they are. I definitely know they are in Florida. I was just in Orlando yesterday. And I'll tell you, it's a mess down there, right? There's other markets that are being rocked too, but I still think this is a great little window, even with the high rates. Because when do you want to buy? It depends on what side of the equation. If you're gonna buy something to move into it, maybe you wait. But who knows where rates will be? If you buy something to invest in, you got to make sure it cash flows, and that's very, very hard to find right now. On my side, I'm finding massive disruption on the commercial, like apartment side, where occupancies are being challenged, vacancies are higher, expenses are higher, interest rates, of course, are higher, and we've been able to buy below replacement costs. So very, very, very different. As a result of everything that got started in 23, 22, is now being leased up and hitting the market right now from a renter standpoint. So it's a really good time for renters right now, but it won't be mark my words, this time next year, you're going to start to see massive stabilization and you're going to start to see rent growth.
Yeah, and I think right now is a good time if you're in a property you don't want to be in and you want a 1031. Now is a good time to do that because we don't know. We could see a decrease in prices, which is not a big deal if you're in something that you want and you're getting cash flow and you're renting it. It is a big deal if you're in something you don't want because you might not be able to easily sell it in this kind of market. So it's kind of a good time if you're trying to get out of something to get out of it before the market gets worse. Because I do think the market's going to get more clogged than it is now.
And there's a lot of talk about the price, and I get that. But you have to look at the whole thing. So you have to look at the interest rate at the time too. And you have to look at the rent. So if you're buying these as investments, the price is important, but it's not necessarily the most important. So if rates went down to 5 today, you guys wouldn't care about the price, is my point.
Right. Prices would probably go up.
Right. This is my point. So prices might come down a little bit. You might get a good deal, but it only is going to be meaningful if rates also come down, right? And as of recently, that has not been the case.
Well, I think the big question is, has the Fed lost control of interest rates? Because if they have, and if they do try to lower and they can't because of the bond market, that's going to be a very interesting situation, and it's definitely going to affect housing prices. Like if the Fed cannot get rates down, it's got to affect prices of things.
I agree. Yeah, I actually don't think that they have much to do with it right now. Mm-hmm. It's certainly looking that way. So if you look at the Fed funds rate has gone down, then why has the 10-year gone up? Period.
Right.
I mean, just look at that. During the same time frame from the beginning of this year, the Fed funds rate has gone down. The Fed and the 10-year has gone up. Mm-hmm. So there you go.
Right.
So
it's going to be interesting. We have, the Fed meets next month or this month. June.
Yeah.
And, we have Trump's tariff pause. So we'll see.
Trump's going to have to take Powell to some coffee or something.
That goes. But there's a lot of unknowns right now. But not a bad time to buy, to be honest. I still don't think it's a bad time to buy.
Well,
I just bought something.
It can be if it's not cash flowing.
Yeah, it's got a cash flow.
You guys got to make sure it cash flows. Don't buy just to buy. Don't buy based on a capital gain. Please do not do that. Do not.
Right.
The goal is not to buy something and fund it.
Well, and right now, if you're betting on appreciation, that's not a good bet. Eventually we'll appreciate, but how long could be a long time.
Right. And again, if you guys are as confused as I am, don't miss the live stream that we have. It's free this Thursday with Robert Kiyosaki and Taro, my partner at Limitless. And of course, we'll be at Limitless at the end of July. I know a lot of you guys want to meet Danille, so don't forget she'll be there. We're going to do a podcast live.
A live podcast.
From Limitless on August 1st. So I hope to see you guys down there too. It's going to be in Dallas again. 50 speakers, 3 stages, 2,000 people, all trying to figure this stuff out.
And let's end on this. Jared said, I think that is why the Fed isn't lowering. They don't want to call their own bluff.
Ooh,
so
that could be.
All right. Yeah. We'll see you guys next week.
Yeah. Hey, happy Memorial Day.
Happy Memorial Day.